In this video, I want to talk about the subject of co-integration. So up until this point now, we've considered that if we have non-stationary time series, then it's not a good idea to regress them on one another. So the idea here being that let's say we had one YT, which was a random walk process, which perhaps looks something like this, and then I had an XT, which similarly was trending upwards, so perhaps it was doing something like this. So the top one here is YT and the bottom one here is XT. Then the trouble here is that even though I've got two completely independent processes, when I look at a scatter plot of YT against XT, they will be significantly correlated with one another. In this circumstance, they will be significantly positively correlated with one another, just because both of the variables are increasing across time. Note that this period here, there will be a period where they are less correlated with one another. So there might be a few points which might be a bit anomalous in general. But the vast majority of the points will be positively correlated, or they will show some degree of correlation, so that when you fit a least squares regression to that line, the parameter beta, which you estimate as the slope parameter, will look like it's statistically significant, even though these variables actually have very little to do with one another. So that's the problem of spurious regression, and that's why often, if we can, we try to avoid using processes which are non-stationary. We generally try to avoid processes which are I1, or we avoid regressing processes which are I1 on one another. But some of the time that isn't good enough. Some of the time we actually need to look at processes which are themselves non-stationary and to look whether there is a relationship between that variable in levels with another variable which is similarly non-stationary. So the idea here is that let's say we have some YT which looks something like this, and then we have some process XT which perhaps looks something like this. So it's not quite increasing at the same rate that YT is, but it's still increasing a bit. So here's YT and here's XT. So the idea with co-integration is that even though my process YT may be I1 and my process XT may itself be I1, then if I find a particular parameter, beta, and I multiply XT by that, then the effect which that has on XT is it causes XT's graph to rotate, and perhaps XT's graph now looks something like this. So this third series which I've drawn on here is a particular parameter value beta times XT. And notice that this particular parameter beta times XT has essentially ensured that the way I've tried to draw it is that the distance between these two variables tends to be relatively constant. So if I was to look at YT minus beta times XT, where, as I stress again, beta is a particular value of the parameter, it's not any value, there is just one value which will satisfy this condition, then if there is truly some relationship between YT and XT which is constant through time, then the process YT minus beta times XT will turn out to be I0. In other words, the distance between these two series, once we've taken account of the scaling factor, will be constant. And when we find that this is the case, that the difference between YT and beta times XT is a stationary process, we say that YT and XT are co-integrated. But what that really means in economic terms is it means that it is possible that there is some sort of true relationship between YT and XT which holds for all time. Notice that in this example up here, the top example where I've drawn two potentially non-stationary time series and there isn't a true relationship between them, then it happens to be the case that the distance between them, there's no way I can multiply XT by any number to make the difference between these two variables appear like it's a stationary process. There's always going to be a discontinuous jump due to this sort of distance here, this change in YT which took place, and there was no corresponding fall off in XT. If XT had done that, for example, that might be more of a sign that there is actually a true relationship between yt and xt. There is no way that I can form a co-integrated relationship between yt and xt up here when I've just got two random walks. So this is a particular circumstance when, even though yt may itself be I1 and xt may be I1, so they're both non-stationary time series, it might still be okay to regress one on the other if we can find a beta such that the difference between these two parameters, or the difference between yt and beta xt, is itself stationary. So that's the one exception that we have to our rule of not using I1 processes in linear regression. In the next few videos, I'm going to explain how we actually go about testing for whether yt and xt are co-integrated. But the principle of looking at a graph of them, as I've done down here in the bottom, and then looking at a graph of yt against beta times xt, is essentially the same thing as what will be going on in these tests.